I'm Sonali Basak, the Chief Investment Strategist at iCapital, and I am joined today on the latest episode of Beyond 60/40 with Raj Dhanda. He is the Global Head of Wealth at Ares, and it's a great time to talk to you about wealth. You've very recently, and congratulations for this, increased your projections on what the wealth channel is going to bring in at Ares to $125 billion, I believe. And I'm really curious as to what's going to get you there. Why is there so much demand for alternative assets in wealth, and what exactly is driving that?
Well, thanks for having me, and congratulations. You
new job
brought a ton of energy and impact to your new job, and welcome to the alts marketplace. We're in a great place today. As you mentioned, we had a strong quarter, but we've been on a journey now for about 5 years, and we think about having products that allow us to be agnostic of any one strategy. So being a multi-solutions platform is important. We think about having the right people and the right investment. The firm's made a commitment that
almost 200 people just for you and under wealth now.
It is, and it's important that it's again tied to the product platform, meaning we can talk about education and provide thought leadership that is a big part of this investment in people. So you have products, we've made an investment in people, and then Ares platform and the brand fits really well in the wealth channel. The history of the firm is in credit. We think about wealth preservation. We think about downside protection, and so we're growing our brand in the channel. And we've had some great success, which we're really proud of.
Right. I'm glad you got to credit, because right now is an interesting moment in the credit markets. Now, to be clear, Ares does a whole lot more than credit these days. We'll talk more about those sectors. But in credit, how are you addressing any client fears at this moment when it comes to what Jamie Dimon is calling cockroaches in the industry? These maybe idiosyncratic or systematic, however you want to put it, losses that are being experienced.
Well, I would step back. So private credit doesn't operate in a bubble. It's part of the broader credit allocation, part of the credit markets, and it's a reflection of the economy. Ares, as you know, has this vast middle markets platform. And so we see the real economy, and the private credit question is part of a bigger debate that goes on every day. But I'll say a few things. One, we think the conditions are stable, and we feel like there hasn't been any turn for the worse. These headlines are fairly isolated, and in the case of fraud, they're fairly specific to some of these recent headlines and conversations around cockroaches, as you say.
Right. Some of the losses were tied to companies that were then allegedly accused of fraud right now.
That's right. So one is we just don't think the markets have really taken any turn for the worse. The second is Ares itself in our portfolios has seen double-digit EBITDA growth. We've seen improving margins. And the most important point that I share with clients is today there's as healthy an equity cushion as we've seen in history. The LTVs are roughly in the low 40s, so you have almost a 60-point cushion that you need to eat through before you see any degradation in values to credit.
It's interesting. I do think that this private credit question at the moment ties so closely into how advisors across the globe really are thinking about private markets. You have them trying to measure twice, cut once. Right? You have them saying, well, okay, if I can't get my money out of these funds, then how am I making sure that I'm in the best managers? Are you finding that dynamic is happening?
We are, absolutely. So the third point is manager selection now really rises to the forefront. When markets are priced for perfection, just about anyone can manage a portfolio of loans. Not today. And in fact, in periods where there has been some volatility or weakness, going back in our 30-year history, Ares tends to gain share, principally because our returns are better than average, better than peers, and better than in the traded markets. So we think private credit is a core allocation to a private markets portfolio. We think you don't want to time it. Institutions for decades have had this consistent allocation that may be geared up and down through cycles, but for the most part, it's floating rate, it's defensive, senior in the capital structure, and part of your broader fixed income allocation. So in that spectrum, it's a core part.
You know, it's so interesting. I kind of boil it down to people as three key risks. You have a risk of credit risk, right, which is kind of what we're talking a little bit about now. There's illiquidity risk or liquidity risk. We can talk about that in a second. And then there's duration risk. And I think that the tailwind for private markets is people are looking at the public fixed income markets and saying, duration's a real risk. Maybe I prefer liquidity risk to holding a 30-year government bond, for example. So that means people need to understand liquidity risk. Some of these products are said to be semi-liquid. Are they really that liquid, though? Should they be even branded that way in so many forms? Because I tell people, if you're taking on the liquidity risk, expect to keep your money there. How should people think about liquidity?
We talk about liquidity all the time. The illiquidity of alts, and I tell them all the time, think of it as an illiquid, non-traded asset class. The illiquidity in individuals' portfolios can be a benefit. And I say that because top financial advisors spend a significant amount of time trying to keep their clients invested during downturns. The elegance of the alts allocation, a private markets allocation, is you put it to the side when markets are volatile, and the advisor and their clients discuss the liquid or public or traded part of their portfolio. And that keeps them invested with managers that have seen these types of markets, know how to deploy capital during the volatile times. So liquidity, which gets debated often as a negative in the private markets, is actually in some regards a positive. Of course, you have to have the context that, as most individuals do, that 70-80% of your portfolio is liquid anyway.
So what does this mean for the products that are semi-liquid that are out there right now? What value is there? And the only reason that I'm asking this is because I think that there's a push in this market to make these products more and more liquid in some fashion.
So liquidity is part of the evolution of these products and one of the things that's made them more attractive, although the liquidity is meant to be for an individual's life and not for a trading opportunity. So people can find liquidity if they need to pay for
taxes,
something,
gifts,
a wedding, anything important in their life. Otherwise, though, the liquidity is not meant to be something that you try and trade around. And the real advantage of these structures is the increased transparency. So a monthly NAV, a quarterly NAV, that has really changed the investment opportunity and made individuals much more comfortable with the private markets. Whether you're moving your money in and out, it's very helpful to see a valuation that gives you directionally some information on your portfolio.
I think that this is a really important part of what you were saying at the beginning, education, thought leadership, because a lot of people will say, well, the private markets, I'm not getting information fast enough. But I think that's changing, where people are getting much more information at a much faster rate about how portfolios are doing. Would you agree with that?
Well, I would, and I think the public markets sometimes trip on this. So Friday was the AI trade was over, and Monday it's back.
It's back on, right.
I'm not sure anyone is equipped other than a machine to trade around that type of news flow.
And even then, a lot of machines got tripped up too, as you know.
Exactly. The private markets are very, very different in cadence. The capital is long-term. The valuations are periodic, monthly, quarterly, so on. And all of that actually leads to an asset allocation approach and not a day trading type mentality. And again, if a client wants to trade in a certain part of their portfolio, we see that often. Advisors will say, here's your money to trade the stock market with. That's not even our core competency anymore. There's not really a moat around trading stocks like there used to be. The real moat and the real differentiated opportunity is in the private markets where an individual can't replicate that.
Right. You can look at all of the historical data and you can see median IRRs are above what you see in public markets, both fixed income and equity. One question I have is some of the greatest private investment opportunities have been institutional for so long and are just starting to open up to individual investors. So, for example, data centers. Data centers are starting to open up. Even parts of private credit. It used to be just those direct lending funds, but now those asset-backed funds are also starting to become much more available, it seems like, to individual investors. Are individual investors getting in at an appropriate time if they have to wait so long to access those opportunities?
Yeah, well, I'm glad you asked. So one of the things that excited me about building the wealth platform was we had the opportunity to have the individual investors sit side by side with institutions. So the portfolio manager, the investment committee, all of the origination deployment that has been principally in our 25-year history for institutions, the last 5 years has been offered to individuals side by side. So the narrative that there's one sort of deals for individuals and one sort of deal flow for institutions, we don't see that. Once you are able to offer a platform like Ares to individuals, it's then about building an allocation over time that is for all cycles and all markets. And the starting point is important. Individuals still, notwithstanding all the growth, are massively underallocated. They're allocating across the U.S. and globally 3-4% of a portfolio to alts. There are platforms that have no alts access. So a lot of this is about beginning to offer that access and providing, as you said, the education so that they can invest in the asset class.
So let's use one of the hottest areas right now, data centers. Ares is very well in tune with this market. This is a really interesting area to me because it's not quite credit, it's kind of real estate, it's kind of infrastructure, and it's tied to a whole lot of things where we don't know where the future will go. So how should investors think about the potential to invest in this very hot theme, and what does the return profile look like for them? Is it really safer than investing in a Magnificent Seven stock?
Well, it's very different than investing in a Mag 7 stock. And the way we think about it is we wrap it into strategies focused on the new economy. Ares has, as you know, built out a global logistics platform that's one of the 3 largest in the world. Logistics being a way to leverage the growth in online shopping through distribution warehouses. Another aspect of the new economy has been self-storage as a sector. We have a key competency. And then data centers is in the news and a topic that is at the forefront of investors' minds. Data centers as well is a hybrid play. It's a opportunity to show an individual investor how to get access to the growing demands for power through the AI hyperscale that we're in. And we think of it as, importantly, something that needs to be diversified exposure. So the assets are large enough, the upside is significant, but there's risk today that not everyone talks about. And so as Ares does often, having a diversified opportunity to invest in data centers, we see real value in. Whether it's something that an individual can put a significant allocation towards is probably a one-on-one conversation based on their risk appetite.
Well, what do you see as the biggest risks?
Well, I think the entry point and and how quickly the market has moved just means you need to be able to have a vertical approach to the asset class. You don't want to only be an investor in the stabilized assets. You want to be able to develop, you want to be able to lease, and then you want to be able to manage the core holdings. And we've got a vertically integrated platform, and I think like any other asset class, there's great opportunity to capitalize on the growth. But I think you just have to measure some of the exposures you get to some of the tenants and make sure that your in-ground pricing is attractive.
Control your luck.
Control your luck.
You know, the other area I want to talk about before I let you go, I was on a podcast myself the other day where the guys were really talking about how they were frustrated that they couldn't access private markets, the most hot new types of investments. They were talking about how billionaires can buy into sports teams, but they couldn't. And I said, well, actually, you kind of can now. And Ares is really at the forefront of this. Explain the future a little bit. Where is this going? And are people really going to be able to buy into some of the fastest growing sports opportunities?
Yeah, they are. And we started investing in sports just prior to COVID and have had a view for a while that providing an opportunity to invest in sports is really differentiated. The demand for live, unscripted content is voracious and is actually generational, meaning it's an opportunity, which is not always the case, that the next generation is leaning into. So we think the demand for live, unscripted sports is one that you can't do in the public markets. To your point, in certain cases, the private markets can deliver that. Ares is doing that. It used to only be billionaires buying a team.
But really, the NFL and the NBA, it was only in recent years that it opened up, right? So even the opportunity for private equity to get in was recent. And now the opportunities for individual investors to get in through private equity is even more recent.
It is. And I think the attractiveness is uncorrelated returns, uncorrelated to your tradable allocation. And the reason I emphasize that is anyone will talk about sports. Everyone has a team. Everyone has something that they're passionate about. And the emotion and passion actually helps the long-term investment thesis. But we keep pivoting our conversations to the investment thesis. We're in the investment business, as you know. So sports opens up a tremendous number of conversations. But it's differentiated. It has uncorrelated returns. And then the other important thing about sports is we're in the early innings. So I'll give you an example. We are investing in women's volleyball. This is the fastest growing sport in America. They had 1.3 million viewers for the women's volleyball championship. Recently, I did my ChatGPT homework 5 years ago. There's no data on how many people watched of the women's volleyball championships. So to go from not really measurable to over 1 million viewers is a huge growth opportunity for women's volleyball. And they need capital. They need the capital to be able to keep up with growing their sport.
Right, because ultimately that's what it comes down to. The investment opportunities to be able to provide that capital to then feel the benefits of these types of teams growing. Raj, thank you for joining us here at iCapital. It's great to see you in person again.
Great to see you again. Congrats and thanks for having me.
Thank you. That is Raj Dhanda. He is the global head of wealth over at Ares for our latest episode of Beyond 6040.